Listen up, investors. The NASDAQ just got slammed, dropping a brutal 2.23% this week. This isn't just a minor hiccup, it's a significant downturn that's sending shockwaves through the market. Tech stocks, the darlings of the index, led the downward charge. Giants like Apple and Microsoft saw their shares plummet, dragging the entire index down with them. It's a sea of red out there, and panic is in the air. The trading floors are in chaos, with investors scrambling to make sense of the sudden drop. But don't you dare hit that sell button just yet. We're diving deep into this market mayhem to give you the insights you need to navigate this storm. Understanding the underlying factors is crucial before making any hasty decisions. This isn't the time to bury your head in the sand. We're talking about your hard-earned money here. It's essential to stay informed and make calculated moves. So buckle up, because we're about to break down this market mess and arm you with the knowledge to make smart investment decisions. We'll analyze the trends, the triggers, and what you can do to protect your portfolio. Remember, fortune favors the bold, and right now, knowledge is your most powerful weapon. Stay tuned, stay sharp, and let's turn this market turmoil into an opportunity. Let's get specific, folks. The tech-heavy NASDAQ took a beating, dragging the overall market down with it. Big players like Apple, Microsoft, and Amazon all closed significantly lower, contributing to the index's decline. We're seeing a classic case of investors taking profits off the table after a long bull run. Tech stocks, in particular, have seen incredible growth over the past few years, and some investors are getting cold feet. But is this a temporary blip or a sign of things to come? Blame it on a mix of factors that are shaking up the financial world. This market dip isn't happening in a vacuum. It's a complex web of interconnected issues. There are several key factors at play, each contributing to the overall market sentiment. First, inflation is still hotter than a firecracker on the 4th of July, making everything from groceries to gas more expensive. And the Federal Reserve is stuck between a rock and a hard place, trying to balance the economy. They need to raise interest rates to combat inflation, but doing so too aggressively could stifle economic growth. But that could trigger a recession, leading to job losses and lower consumer spending. Talk about a tightrope walk. It's a delicate balancing act with no easy answers. Second, the ongoing conflict in Europe is adding fuel to the fire, causing further instability, creating uncertainty and volatility in global markets, making investors jittery. And let's not forget about China's economic slowdown, which is another major concern, which is putting pressure on global growth, affecting everything from manufacturing to tech. It's a perfect storm of negative headlines, creating a sense of doom and gloom, and investors are getting spooked, pulling their money out of the markets. But remember, there's always opportunity in chaos. Savvy investors know this well. This market pullback could be a chance to scoop up some bargains on quality companies that have been unfairly punished. So keep your eyes open and stay informed. Section 4, the week ahead, what to watch. Keep your eyes peeled for these key data points coming out next week. Consumer Price Index data on Tuesday, Producer Price Index data on Wednesday, and retail sales figures on Friday. These reports will give us a better read on the health of the economy and the Fed's likely course of action. Pay close attention to these reports, folks. They could make or break the market in the short term. We'll be watching these numbers like hawks, and we'll be sure to keep you updated on any major developments. Section 5. Charts don't lie. Reading the NASDAQ's future. Now, let's talk technicals. The NASDAQ is currently trading below its 50-day moving average, a bearish signal. We're also seeing a classic head and shoulders pattern forming on the charts, which could indicate further downside ahead. However, it's not all doom and gloom. The index is finding support around the 14,000 level, which could be a sign that buyers are stepping in. We need to see some positive momentum in the coming days to confirm this, though. Section 6. Recommendations for investors. So, what's an investor to do? First of all, don't panic. It's crucial to keep a level head during times of market volatility. Emotional decisions can often lead to costly mistakes. This market correction was long overdue, and it's perfectly normal for the market to take a breather after a strong run. Historically, markets have always experienced ups and downs, and this is just part of the natural cycle. Now is the time to review your portfolio and make sure you're well diversified. Diversification helps spread risk and can protect your investments from significant losses. Don't have all your eggs in one basket, especially not in the tech basket right now. Tech stocks have been particularly volatile, and overexposure can be risky. Consider adding some value stocks to your portfolio, as they tend to hold up better in a rising interest rate environment. Value stocks are often undervalued by the market and can provide stability. Remember, this market volatility is a marathon, not a sprint. Long-term strategies often yield better results than trying to time the market. Stay disciplined, stay informed, and don't be afraid to take advantage of opportunities as they arise. Keep learning and adapting to market conditions to make the most of your investments. Section 7. Conclusion. The market may be down, but it's not out. This too shall pass. Keep your cool, stick to your investment plan, and remember that long-term investors have time on their side. As always, stay informed, stay educated, and stay invested.